In this video we are going to talk about high-return dividend stocks. So before starting this video, please like this video and subscribe to our channel for future updates. Dividend stocks with high yields are highly sought after by income investors. One of the finest methods to make passive income on Wall Street is to pay out dividends that are higher than the market average. That said, starting positions in companies with the highest yields isn't enough. There's a lot more to think about. When analyzing the quality of high-yield dividend stocks, prospective investors should analyze a variety of variables, including the company's health, competitive advantage, moat, financial condition, track record, and industry, to mention a few. Investors will be exposed to danger if they don't account for all variables, which is why it's critical to know everything there is to know about high-yield dividend stocks. Make sure you brush up on your fundamentals before thinking about the finest high-yield dividend stocks in 2021. Number 10. Abbvie Inc. It's difficult not to mention the aristocrats when talking about dividend stocks. Abbvie is one of the most well-established dividend aristocrats investors should be enthusiastic about in 2021, having provided 49 consecutive years of dividend growth. Not only does the pharmaceutical firm's track record speak for itself, but its future prospects appear to be equally promising. Abbvie's revenue climbed 59% year-over-year last year, which is outstanding for such a well-established corporation. More importantly, Abbvie has a solid pipeline of upcoming medicine releases, which could keep the dividend growing for years to come. Number 9. Federal Realty Investment Trust. Federal Realty Investment Trust has become known as one of the industry's top and highest-paying REITs. FRT is a real estate investment trust, REIT, that owns, operates, and redevelops high-quality retail buildings in some of today's most exciting cities. Federal Realty's mission has grown into one of the shareholders over the course of its 60-year history. Shareholders receive access to continued gains by creating long-term, sustainable growth through retail properties. As a result, the dividend is thought to be quite safe, with plenty of possibility for growth. Number 8. Ryman Hospitality Properties, Inc. Ryman Hospitality Buildings, Inc. owns 5 irreplaceable convention center properties that are managed by Marriott International and operate under the Gaylord Hotels brand. Many of the company's major holdings, such as the Grand Ole Opry in Nashville, Tennessee, are one of a kind and attract people from all over the United States. Ryman Hotel, on the other hand, was heavily damaged by the pandemic as a REIT in the hospitality industry, specifically one focused on major conventions. As a result, it decided to stop paying out dividends in order to keep its financials in order and invest in itself. As the country was shut down, Ryman Hospitality expanded its portfolio by renovating several of its closed facilities to make them more appealing than they were before the outbreak. As a result, every one of the company's properties stands to benefit from the country's reopening as soon as possible. When business picks up, the company's dividend will follow suit. Number 7. Healthpeak Properties, Inc. Healthpeak is well positioned to benefit from the aging baby boomer demographic. As the population ages, more people will become reliant on assisted living and medical institutions. This is where Healthpeak comes in. According to Yahoo Finance, Healthpeak owns and develops high-quality real estate in the 3 private pay healthcare asset classes of life science, medical office, and senior housing, with the goal of providing stability during industry cycles. This REIT appears to be a good long-term investment, and its diversification across several sites also helps to reduce risk. At the very least, Healthpeak's business model should ensure that dividends are protected for a long period. Number 6. STORE Capital Corporation. STORE Capital Corporation is a net lease real estate investment trust that is frequently compared to Realty Income Corporation, one of the most well-known REITs on the market. By focusing on the acquisition of net lease investment properties, both companies prioritize dividends for investors. STORE has a well-diversified portfolio that includes assets in more than 2,500 property sites across the United States, whereas Realty Income has accumulated more than 6,500 properties over the course of its 52-year operational history. Although the comparisons are valid, STORE is a superior value and has greater possibility for growth. Perhaps more significant, STORE is well positioned to benefit from the forthcoming thesis reopening. STORE could burst out at any time with the news of new acquisitions, as real estate investment trusts have been restrained for far too long. Number 5. STAG Industrial, Inc. STAG Industrial, Inc. is a real estate investment trust that is hoping to profit from the e-commerce craze. The demand for warehouses is growing as more retailers shift to online sales, and STAG is in a unique position to provide merchants with exactly what they require. STAG leases commercial property space that could be used to host the e-commerce of the future, and its dividend is presently appealing. However, STAG's 4.11% dividend will profit not only from the world reopening in the aftermath of the coronavirus, but it will also be a major beneficiary of the e-commerce secular tailwind. STAG will be close behind corporations like Amazon, which need warehouses to keep their items, as e-commerce continues to expand market dominance. Number 4. Brookfield Renewable Partners. Brookfield Asset Management Inc. is a real estate, renewable energy, infrastructure, and private equity-focused alternative asset management firm. Brookfield Renewable Partners, on the other hand, is a subsidiary of Brookfield Asset Management, a firm that appears to be well-positioned to benefit from a greener future. Brookfield Renewable Partners, as its name suggests, owns and runs renewable energy infrastructure. Brookfield Renewable is likely to pick up a lot of the slack, as most companies have already moved away from fossil fuels. Its dividend is quite stable and likely to expand, thanks to many contracts signed for decades down the road. BEP's dividend yield of 3.16% is high enough to put it in the debate of best high-yield dividends, but the true promise appears to lie in the company's development. Few renewable energy firms appear to be better positioned to power a greener world than BEP, and the company's dividend should only grow as it adds to the global power grid. If that wasn't enough, Brookfield has a solid track record, making it a safe bet for long-term investors. Number 3. Qualcomm Incorporated. With a dividend yield of 2.08%, some may question whether Qualcomm belongs in the topic of top high-yield dividend stocks. The dividend yield of Qualcomm is less than half that of the other businesses on this list. Qualcomm, on the other hand, is down almost 22% from recent highs, which appears to be an overreaction to a positive earnings announcement and a market-wide tech sell-off. Overall, Qualcomm suffered a bigger knock in the first quarter than it deserved, especially after reporting a record-breaking quarter. Although revenue climbed by 52% and adjusted earnings more than doubled in the most recent quarter, the company still trades at a discount to the industry average. The price-earnings to growth ratio, PEG ratio, of Qualcomm is 0.69x. In the semiconductors industry, Qualcomm's current valuation appears to be a bargain at that level. Qualcomm not only appears to be a good buy, but it also appears to be capable of providing income investors with a lot of growth. As a key player in the 5G rollout, Qualcomm's relatively low dividend yield could become more appealing over time as the company's growth prospects improve. Number 2. Kinder Morgan, Inc. Kinder Morgan is a part of North America's energy infrastructure. Kinder Morgan owns and operates natural gas pipelines, product pipelines, terminals, and CO2 divisions, amongst other things. Kinder Morgan is noticeably absent from the renewable and green energy industries, but investors should not overlook one of today's top high-yield dividend companies. Even with the imminent danger of renewables, Kinder Morgan's future is secure. If the recent Colonial Pipeline hack taught us anything, it's that natural gas is still feasible and vital, and will be for the foreseeable future. KMI shares, on the other hand, have been undervalued due to the potential threat of renewables. While not as inexpensive as they were this time last year, KMI shares are currently trading at a decent price-to-earnings ratio of 23.02x, which is slightly lower than the industry average. Furthermore, and probably most crucially, the company's 5.85% dividend yield is both appealing and secure. Number 1. Simon Property Group, Inc. SPG has become identified with the world's greatest mall operators as a real estate investment trust that specializes in retail, dining, entertainment, and mixed-use destinations. Few REITs in the mixed-use market, for that matter, can match Simon Property Group's performance. However, when the coronavirus was officially designated a pandemic, this REIT took a huge step back. Despite the fact that it has recovered substantially, its stock still trades at a 9.0% discount to where it was at the start of the year, right before the pandemic. SPG also used the downtime it was forced to experience in 2020 to bolster its portfolio. Many of SPG's vacancies have been converted into multi-family homes, hotels, healthcare institutions, offices, and self-storage facilities in the recent year. SPG will become a dual threat as a result of their decision to diversify their portfolio even more at a time when the economy is opening up and ready to start purchasing again. What are your thoughts on our video? Have you invested in any of above dividend stock? Please let us know in the comments section below. If you enjoyed this video and would like to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.